Okay, so we are learning how to calculate the amount of interest on a given loan amount, and then we are going to learn how to actually journalize when we allow a customer to take out a promissory note with our business, as well as whenever we receive payments from those customers for those promissory notes and how they affect their accounts receivable account. So first thing we're going to do over here on the left-hand side is calculating the maturity date, which is the date that they need to pay their loan off by, or excuse me, their note receivable. What's the last day that they need to pay it by, determining how many days we allot for them. So notes receivable number 3, we've got a customer that's borrowing $20,000 at 8% interest, and they have 90 days to pay it back. So they take their notes receivable out on June 5th. So from June 5th to June 30th, that's 25 days in the month of June that they are borrowing that money from us. So we take 90 minus those 25 days in June. At the end of June, they'll have 65 days left on their notes receivable promissory date or maturity date. July 1st to the 31st, that's 31 days. So we take the 65 remaining days at the end of June minus the 31 days in July. So at the end of July, they'll have 34 days left to pay their notes receivable back. August 1st to the 31st, we've got 31 days. So it's 34 minus the 31 days in August. So at the end of August, they have 3 days, which means their maturity date is going to be the 3rd of September. So they need to pay their loan back to us by September 3rd. So that is their maturity date of when they'll have 0 days left. So over here, calculating the interest. Interest is calculated by taking the principal amount times the interest rate times the days divided by the total days in a year. So we're going to use this to figure out and lay out that formula. So this first box is the principal amount. So we've got $20,000. Our interest rate is 8%. And then our days out of 360 is 90 divided by 360. Okay. When you make that calculation, that interest amount will go over here in this box. So I'll do a formula equals, we'll do 20,000 times the 0.08, 8% times, I'm going to put this one in parentheses, 90 days divided by 360. Okay, so $400 in interest. This first box is for the principal amount. As you take your principal plus your interest, that gives you how much total value is owed at the maturity date. So we'll do the notes receivable number 4. So this was taken out June 12th. They are asking for $10,000 at 6% interest and 120 days to pay it back. So from June 12th to the 30th, that's 18 days. So 120. Did I get it? One. So equals 120 minus the 18 days. So at the end of June, they have 102 days left to pay. And we've got 31 days in July. So 102 minus the 31 days in July. At the end of July, they'll have 71 days left. 31 days in August. So at the end of August, 71 minus 31, they'll have 40 days left. September has 30 days in it. So 40 minus the 30 days of September, they'll have 10 days left, which means they have to pay that loan back by October 10th. Is when their 120 days runs out. All right, so let's calculate the interest. So their principal amount was 10%, and our interest rate's 6%. Sorry, $10,000. Interest rate is 6%, and then the number of days is 120 divided by 360. Let's make that calculation equals 10,000 times the 0.06 times 120 divided by 360. $200 in interest. and our original principal balance was $10,000. So $10,000 plus the $200 in interest means at the end of the loan, they will owe us back $10,200. This table here, which I've already pre-filled in, you'll need to fill yours in when you do your application problem, but it's basically just transferring these numbers down into your chart. So interest for notes receivable 3 was $400. Interest for notes receivable 4 was $200. The maturity date we found for the number 3 was September 3rd. Maturity date for note receivable 4 is October 10th. And then the total value that they owe us on that maturity date, $20,400 and $10,200. Okay, so let's practice on recording notes receivable transactions. So July 5th accepted a 90-day 8% note from Gary Kinney for an extension of time on his account. So $1,800 is what he's asking for. So we're going to record the date, July 5th. Our notes receivable account is increasing, and he is borrowing money from us to pay down his notes receivable account for the time being. So this is for notes receivable 5 is our document number. We'll come back and fill in the post reference once we post them to their individual ledgers. So he's asking for $1,800 to pay down that account. Okay. Transaction on July 12th. Received cash from Mary James for the maturity value of the notes receivable 1, a 60-day 9% note of $500. So since we're receiving cash, that's going to go on our cash receipts journal. So our date of July 12th, our notes receivable account is going to be affected, as well as our interest income that we're making from her borrowing that money. The check number is receipt 113. Again, we'll fill out post reference once we post to their individual ledgers. Our notes receivable, since we're receiving payment, it's making the notes receivable account decrease, which would be a credit. So we're crediting that notes receivable account $500, and then the interest income account is going to be credited for the interest on the $500. So just like we calculated interest over here, that's the same way we would calculate interest for here. So it'd be 500 times the 9% times 60 days out of 360. So in total, we're going to get interest income of $7.50. So those two amounts together, we should receive $507.50 from Mary James. All right, last transaction, July 26th, Dennis Kraft, he dishonored his notes receivable too. So that means we need to credit back his accounts receivable account, so make it increase back up, and decrease our notes receivable account since he's not going to pay us. All right, July 26th, accounts receivable, Dennis Kraft. Our notes receivable account is going to be a credit, and interest income is a credit. This is memo 25 is our document number. So we're going to wait to fill in this number because it's going to be the notes receivable plus the interest income. So he owes us $400 for original loan, but now we're going to credit his accounts receivable account of the money that he owes us plus the interest. So it's going to be $400 times 0.09 times 90 days out of 360. So interest of $9. He'll owe us, we're debiting his accounts receivable account $409. So now he will show that he owes us $409. We can go ahead and fill in the account numbers. So our notes receivable account number is 1170, 1170, 1170, 1170. Our interest income is 7110, 7110, and then accounts receivable is 1130, so 1130, and Gary Kinney is 120, so 1130 backslash 120, 1130 backslash 110 for Dennis Kraft. Now we're ready to record these on their individual ledgers. So the transaction affecting Dennis Kraft was for his dishonored note. So that was on July 26th. Our item description is going to be dishonored note. And then our post reference is that general journal page 7. And he is being debited $409.00. So his debit balance will be $409. Gary Kinney, his transaction was July 5th. And it is for, let's see, we accepted a note. Accepted note. Journal 7. He's being credited $1,800. So his debit balance of $1,800 minus $1,800 that he took a note out for brings his accounts receivable ledger down to 0. All right, and we need to record both the accounts receivable lines. One is a credit and one is a debit. 1,800 and 409. So this is on the 5th and the 26th. Journal 7, Journal 7. So the 42, since it's debit and credit, they subtract one another. And then debit and debit, those will add together. So right now we have customers that owe us a total of $40,790. All right, our notes receivable transactions. We've got the 5th, the 12th, and the 26th. The 5th is from General Journal 7. 26th is from cash receipts, or sorry, the 12th is cash receipts 8, General Journal 7. So on the 5th, that was $1,800 debit. And then both the 12th and the 26th were credits of $500 and $400. All right, so our debits add together. And then our credits subtract off. So right now, $17,100 of notes receivable money that customers are borrowing from us. Last one is the interest income, so how much income we've made from making these loans to customers. We've got one on the 12th and one on the 26th. One on the 12th is for the cash receipts journal 8. One on the 26th is from the general journal. Both of these are credits. Interest income is considered a equity account, so that's why it's credit. All right, so far it's saying we've earned to date this year $474.50 from customers taking out notes receivables with our company. All right, you just need to do the same exact stuff on this application 4.3.